They were 3 hours away from breaking the silver market. Then COMEX changed the rules. February 1st, 2021. WallStreetBets, fresh off the GameStop squeeze that cost hedge funds billions, turned their attention to silver. The logic was simple. If a small group of retail traders could force a short squeeze on one heavily shorted stock, what could millions of them do to a commodity market where short positions were even larger and the actual physical metal was scarce? The call went out across Reddit. Buy physical silver. Buy silver futures. Buy mining stocks. Force delivery. Break the fractional reserve system. Expose the manipulation. Make the banks pay. Within 24 hours, silver moved from an obscure corner of the precious metals market to the most discussed investment on the internet. What happened next almost worked. And the fact that it didn't tells you everything about how the system protects itself when it's actually threatened. Let me show you how close they got. Let me show you exactly what Reddit got right. And let me show you why the establishment had to change the rules in real time to prevent a collapse that would have exposed the entire precious metals manipulation scheme. January 28, 2021. GameStop peaks at $483. Hedge funds are reeling. Retail traders have discovered they can coordinate through social media to force short squeezes on heavily manipulated positions. The question everyone on WallStreetBets is asking, what's next? What other market is heavily shorted, manipulated by institutions, and vulnerable to a coordinated retail attack? Silver gets mentioned in multiple threads. The thesis is compelling. COMEX holds approximately 350 million ounces in registered vaults, but there are over 1.2 billion ounces worth of paper claims against that metal through futures contracts, ETFs, and bank accounts. That's a 3.4 to 1 ratio of paper to physical. If even 30% of paper holders demand delivery, the system breaks. The strategy is posted, discussed, refined. Step 1. Buy physical silver from dealers to drain retail supply. Step 2. Buy SLV shares and demand conversion to physical to drain ETF inventory. Step 3. Buy silver futures and stand for delivery to drain COMEX registered stocks. Step 4. Hold and don't sell, forcing the short sellers to cover at any price. January 29th. The buying begins. Retail silver dealers see order volumes increase by 800% overnight. American Silver Eagles, the most popular retail coin, sell out at major dealers within hours. Premiums over spot price jump from $3 to $6 to $8. Some dealers suspend sales entirely because they can't source inventory. Wholesalers are getting cleaned out. The spot price of silver on January 29th opens at $26.95. By market close, it's at $27.33, a modest 1.4% gain. But the real action is in the physical market. The disconnect between paper price and physical availability is becoming obvious. You can sell paper silver at $27, but you can't buy physical silver at $27. The real price for delivery is $35 to $38 when you factor in premiums and availability. January 30th and 31st are weekend days. Markets closed. But the Reddit threads are on fire. Thousands of posts documenting sold-out dealers, showing receipts for physical purchases, discussing strategy. The momentum is building. Monday, February 1st is going to be massive. February 1st, 2021. Silver opens at $27.50. Within the first hour of trading, it hits $29.35. A 6.7% move in 1 hour. This is a commodity market. These don't move 6% in a day, let alone 1 hour. Volume is extraordinary. Futures volume is 3 times normal. SLV, the largest silver ETF, sees record inflows. Over $100 million in retail money flowing into silver in a single morning. By 11:30 a.m. Eastern, silver touches $30. This is a critical psychological level. It's a 4-year high. More importantly, it's approaching the strike prices where massive amounts of call options become in the money. If silver closes above $30, market makers will need to hedge those options by buying futures, creating additional buying pressure. The gamma squeeze is starting. Retail investors are posting screenshots. We're doing it. Hold the line. Don't sell. The energy is similar to GameStop. The belief is that if they can push silver above $30 and hold it there, the short sellers will be forced to cover, just like with GME. But here's what Reddit didn't fully understand. Unlike GameStop, where the short position was held by a few hedge funds, the silver short position is held by the banks themselves. JP Morgan, HSBC, Bank of America. These aren't hedge funds that can be squeezed into bankruptcy. These are systemically important financial institutions, and they have tools that hedge funds don't. 12:47 p.m. Eastern, February 1st. COMEX announces an immediate 18% increase in silver futures margin requirements, effective immediately. Not tomorrow, not next week, immediately, in the middle of a trading day during a short squeeze. This means anyone holding leveraged silver futures positions needs to deposit substantially more cash, or their positions will be liquidated. The announcement hits the market like a bomb. Silver falls from $29.80 to $28.50 in minutes. The forced liquidations begin. Retail traders using leverage are getting margin calls they can't meet. Their positions get automatically closed. The buying pressure that was pushing silver up suddenly becomes selling pressure pushing it down. By market close February 1st, silver is at $27.11. Down 1.4% on the day. The squeeze is broken. Not because retail sellers gave up. Not because the thesis was wrong. Because the exchange changed the rules in the middle of the game. But it doesn't stop there. February 2nd, silver opens lower but rallies during the day, closing at $27.68. Retail is still buying physical. Dealers are still sold out. The thesis hasn't changed. February 3rd, silver hits another brief high above $29 before selling pressure knocks it back down. Then the media narrative kicks in. CNBC, Bloomberg, Reuters, all running stories about how the silver squeeze failed, how retail investors got crushed, how silver is too big, too manipulated, too dangerous for retail to challenge institutional positions. The message is clear. Don't try this again. But here's what the media coverage missed. Here's what Reddit actually got right. The physical silver shortage was real. Dealers were cleaned out for weeks. Wholesalers couldn't source inventory. Premiums stayed elevated at $8 to $10 over spot for a month. The disconnect between paper and physical was exposed. SLV, the supposed physically backed silver ETF, added 100 million ounces to inventory in a single week. Where did that silver come from? The prospectus says they buy physical silver when shares are created. But there wasn't 100 million ounces of available physical silver to buy. COMEX registered stocks barely budged. So where did it come from? Either SLV doesn't actually hold all the physical silver they claim, or they were able to source metal that wasn't supposed to exist. Either way, retail was right to be suspicious. The mining stocks responded exactly as Reddit predicted. AG, First Majestic Silver, jumped from $12 to $20. PAAS, Pan American Silver, ran from $31 to $42. These were real moves based on real buying pressure and real thesis about physical silver scarcity. Retail made money on these positions, even though the future squeeze failed. Most importantly, Reddit exposed the mechanism. They showed that when retail coordinates to demand physical delivery, the system panics. They proved that COMEX will change rules rather than allow the fractional reserve structure to be exposed. They demonstrated that banks have tools retail doesn't, and they'll use them to protect short positions. So what did Reddit get wrong? They underestimated how quickly and decisively the system would respond. They thought they had days or weeks to build pressure. They had hours. They assumed margin rules were fixed. They learned that exchanges can change rules immediately when systemically important banks are threatened. They believed the same tactics that worked on GameStop would work on silver. They discovered that commodity exchanges have more regulatory capture than stock exchanges. But here's the question that matters. What if they tried again? What if they did it differently? What if they learned from February 2021 and approached a silver squeeze with better strategy? First lesson: physical only. No futures, no leverage, just physical metal and allocated storage. You can't be margin called on metal you actually own. The exchange can't liquidate your position if you're not using the exchange. The attack vector has to be draining physical supply, not squeezing paper positions. Second lesson: longer timeline. The February squeeze tried to force a move in days. That's too fast. The banks can change rules faster than retail can execute. A successful squeeze needs months of sustained buying pressure that slowly drains vaults until the system can't adjust fast enough. Third lesson: coordination across multiple fronts, not just SLV, not just futures, physical from dealers, PSLV redemptions, allocated accounts, mining stocks, all simultaneously. Make the banks defend multiple positions at once so they can't concentrate their response. Fourth lesson: understand the goal. February's goal was to squeeze banks for profit. Better goal: expose the fractional reserve system and force transparency. Don't try to make money on the squeeze. Try to break confidence in paper silver so that holders demand physical. That's a win even if paper price doesn't explode. Here's what makes this interesting. The conditions are more favorable now than they were in February 2021. Why? Because industrial demand has increased. Solar panel production is consuming more silver. EV manufacturing is consuming more silver. 5G infrastructure is consuming more silver. The deficit between mine supply and industrial demand is wider now than it was then. This means there's less available silver to absorb a retail buying surge. In 2021, the system had some slack. In 2024, the system is already tight. A coordinated retail move now would hit an inventory position that's more vulnerable. COMEX registered stocks in February 2021 were 150 million ounces. Today, they're 280 million ounces. That sounds like more supply, but open interest is also higher. The ratio hasn't improved. It's gotten worse. And that 280 million ounces is being pulled from all directions, not just retail. Industrial users need it. ETFs need it. Banks need it to back their short positions. There's less cushion than the raw numbers suggest. So could a silver squeeze work now? Could retail traders learning from February 2021 successfully force a collapse of the fractional reserve system? The mechanics say yes. The precedent says the system will change rules to prevent it. But here's the key question. Can they change rules fast enough if the pressure comes from physical demand rather than futures positions? February 2021 taught us that retail has power. It taught us that coordinated action can force major institutions to respond. It taught us that the silver market is more fragile than institutions admit. Most importantly, it taught us that Reddit got the thesis right. They just ran into an opponent that could change the rules of the game. The question isn't whether the silver squeeze could work. The question is whether retail is willing to play a longer game with tactics the system can't easily counter. February 2021 was round one. The banks won. But retail learned more from losing than the banks learned from winning. And in a system this fragile, that might be enough.